Welcome. We are watching the stock market live, crashing. The SPY is down a lot. Let's take a look at the daily chart here. And it's really it's been taking a beating here, guys.
Where everything edgy the market is. I know I keep using that word, but it just feels like that's where we are. I don't want to necessarily use unsettled that much. It just doesn't. It's orderly what's happening. Obviously, it's not like, you know, the S&P is only down like 4%, so it's not been this tremendous decline by any stretch of the imagination. It just raises the pressure on Nvidia next week, because otherwise it's an earnings air pocket. There's really nothing going on. You got Jackson Hole. You don't think the Fed's going to go in September. Most people don't. So what do you have? You got one of the biggest now stocks in the market reporting earnings next week that's had a massive run, has had a little bit of a pullback, and now some questions as to whether it's going to pull back further.
Yeah, no pressure, right? So if we look at NVIDIA, its earnings estimates for 2024 went up 75% following that May quarter. So it'd be a lot to imagine that it would still have a similar move higher, that similar kind of beat. But I think if we look at the semiconductors overall, they're down now about 10% from their high. If you retrace another 8%, you will have closed the entire post-NVIDIA move from early May. So that's probably an opportunity to revisit the space once we've seen some of that washout. But it is an important tell, and I think so goes NVIDIA, so goes the market.
So we haven't really discussed it yet, but there's something within the market that I think is so incredibly important. Why are bonds not rallying? The S&P 500 is declining significantly. It's in the midst of a very strong correction. Why are bonds not a safe haven asset? That just increases the pressure on Chairman Powell next week at Jackson Hole tremendously. The concept of fighting the Fed, hedge funds and speculators who are short treasuries, they're fighting and they're winning. And I will say this, he has a very difficult job because he potentially could send the bond market parabolic if he signals something that is uncomfortable to investors. The bond market is not doing what it's supposed to be doing in this environment. It's not supposed to be selling off.
The 10-year yield, guys, is dropping like a rock.
Yeah, I think Joe's absolutely right. There is a lot of pressure on Powell in terms of what he says. Everything will be clearly very important. I think he's going to basically follow the lead of John Williams, the president of the Federal Reserve Bank of New York, and say, look, we're seeing some signs of progress on bringing inflation down, and if it continues to come down, then we're probably going to have to lower interest rates next year simply to avoid becoming even more restrictive in terms of real interest rates. So I'm expecting him to say that, because I think he realizes that if he doesn't say that and the bond yield goes parabolic, as Joe said, that would be a disaster for the banking system in terms of commercial real estate defaults.
Well, you know, Ed, I want to come back to you on something you suggested earlier about, you know, your level of bullishness after we had the kind of first half that we have. I mean, you still have an extraordinarily lofty target, some would suggest, for the S&P. And, you know, it was only a few weeks ago in which you suggested there was still a lot of room to run for this bull market, which you suggested this undeniably was.
Yeah, well, look, I think we've been in a bullish channel in the market. I did think that when we got to 4,600 at the end of July, that was my target for the end of the year, and so I turned more cautious, and I do see this sell-off is continuing somewhat. But I think this is a short-term phenomenon. I think it'll turn out to be a buying opportunity, and I see 5,400 on the S&P 500 by the end of next year. I've been at the top end of the range of earnings expectations. I'm still using 225 for this year, 250 for next year, and 270 for 2024. Multiply 270 by a multiple of 20, and you get 5,400, which incorporates the view that the mega cap 8 are here to stay, and they're going to continue to keep the valuation multiple of the S&P 500 elevated relative to history.
Ed really hit the nail on the head, right? Yes, his projection is lofty because it's all based on a much improved earnings picture. And projections for next year have gone up, right? You've had 3 straight quarters of negative earnings growth. We all know that story, but the projections would tell a far different story as you get into next year.
Yeah, what's already priced into the market today is 12% earnings growth in 2024. And the question we've been asking is how much higher can that go? What you have baked into that estimate is a return to record margins, which is a little bit of a stretch, mostly without inflation. Inflation is good for margins in the sense it drives revenue growth. Revenue growth drives incremental margins. If that starts to decelerate with lower inflation, then that's where you start to ask the question of, if it's not 12%, can it really be 15 or 17, or is it more like 9?
You think, Joe, we're still too lofty in what our earnings expectations are for next year? Because I mean, the market starts to, as you know better than most.
There's a big selling
The market
candle right
has
here, guys.
that tendency to look ahead
A lot of
by
volume
whether it's 6 to
coming
9
in.
months or what have you. So, it's going to anticipate an
See how the
improving earnings
QQQs,
picture, which is one of the reasons why the market was able to rally to the degree that it did.
Sure.
Because you assume that earnings are going to get better in the near term rather than too far
Trying to push
down the
back
road. Do
here,
we need to
guys, see
rethink
that?
that?
I don't think you have enough evidence to suggest you need
5-minute
to
chart
rethink
right
that
here.
right now. I do think the upcoming quarter is a prove me quarter. I think
Big
it's
sell-off here in
guilty
the,
until proven
MACD.
innocent. Because as you look forward over the coming 3 or 4 quarters, the current expectation is you're back to double-digit earnings growth once again. So there was enough
If you leave any
in
comments, if you want
the
me to check out
latest
a
release
stock
of
for you, I'm
earnings
more than
to
happy
feel
to do that.
comfortable that the inflationary pressures were beginning to mitigate the effect of compressing margins significantly. But I think you still need another quarter of evidence to feel comfortable that the expectations as we look forward into the future, they're realistic.
I'm looking at a couple of sectors, Ed, and I want your opinion on them too. In terms of we can get away from technology
There
and
it
comm
is, shows some
services and things
resistance.
that we obviously know if they're
Power
weaker, the
hour.
market's going to be
Look at that
having a
bottom tail
problem.
of that candle,
Discretionary
guys.
over the last
That
week is down
big,
4%. The banks are down 2
big
2/3%.
resistance here.
Just comment to me on the importance right now of
Yeah,
those
we're
2
below the
areas.
50-day
The
moving
consumer's
average,
been
so
a large part of this story. We know that.
Significant drop
The
here.
banks had traded well
That
for a
red
bit, and
line's
I'm just
50-day
wondering,
moving
how
average.
you would characterize the importance that they have
We go
at the given
here.
time when you're already
well,
feeling
well,
as edgy as we've said the
Tough to
markets
see there,
look.
but
Well, I think a lot of this
50 dollars.
edginess is seasonal. I think a lot of the edginess is related to fears that the bond yield is going to go a lot higher. All of this is going to depend on the inflation news. And if I'm right and the inflation news continues to moderate, then I think this edginess will evaporate and that we will have a year-end rally going into 2024. With regards to the performance of the sectors, I think they're acting consistent
happens
with
here.
a fairly
It'll be
broad
interesting.
pullback in the market here. As Joe pointed out, energy is the outlier. A little bit of a mini deja vu of the bear market where the energy stocks outperformed everything else. But I think it's just a mini version of that. I think that the consumer's in great shape and the
Please
financials.
subscribe,
I'm
support our
looking
channel. We're
for
trying to get
just a
100
wave
subscriptions.
of M&A
Hit the like
activity. The
button,
small
helps get it out there.
mid-cap
We appreciate
banks
your
are
support.
going to have to go through that because they're dealing with some pretty hefty regulatory costs, and that'll be a requirement for cutting their costs.
All right, we're going to leave it there. Ed, I so much appreciate you jumping on with
Sure.
us as we watch these markets
Anytime.
over the final stretch. Joe, thank you. Of course, Cameron, to you as well. See everybody soon. Let's get to our question of the day today. We want to know, do you think Apple will trade into the 150s? Head to @CNBC Closing Bell on X, formerly known as Twitter. Please vote yes or no. The results later on in the hour. Let's get a check now on some top stocks. Christina Partsenevelos is watching as we head towards the close. Christina?
Thanks, Scott. Well, the same macro concerns weighing on the broader market appear to be overshadowing a very strong quarter for Walmart. The retailer beat estimates and raised its full-year forecast. The CFO, John David Rainey, told CNBC earlier that there was modest improvement in sales of big-ticket and discretionary items. Nonetheless, shares are down 2.5% right now. Hawaiian Electric is falling again as the Wall Street Journal reports that the utility company is in talks with restructuring firms over its potential liability in the Maui wildfires. The stock is trading right now at its lowest level since March 1985 and heading for its worst week ever, down over 65%. And today it's down 21%. Scott?
Yeah. Christina, thank you. We'll see you soon. We're just getting started right here on Closing Bell. Up next, betting on a bull market. Chris Heisey from Merrill and Bank of America Private Bank is back, breaking down his strategy as we wrap up the summer, look towards the end of the year. We're live from the New York Stock Exchange. You're watching Closing Bell on CNBC. At this very moment, the Dow Jones Industrial Average is down near 300 points. We're back after this.
Com.
All right, we're back. Stocks on track for their third straight day of losses. The 10-year yield hitting its highest level now since October of 2022. My next guest is seeing a light at the end of the tunnel, though, calling for a new profits-driven bull market over the next 6 months. Let's bring in Chris Heisey of Merrill and Bank of America Private Bank. Good to see you, Chris. Welcome back.
You too, Scott, as always.
With a headline like that, it sounds to me like, given our conversations that I recall having, you're more positive on the market than you've been in at least the last 12 months.
Yeah, I think it's important to put it into context. The positivity is really coming what is in store for the back half of 24. You've been covering a little bit of this recently, which is the market looks forward 6 to 9 months, sometimes a little bit longer than that. Next year's story, I don't want to get ahead of it here, but next year's story is about a drop in yields. We can't see it right now. But with what we're seeing in the slow growth trends, there's some strains out there well covered coming out of China for sure. And then in the United States, what we're starting to see is a little bit of drag from the positive real yields, which hasn't been discussed enough, going from negative real yields to positive real yields with a wide gap, negative leading indicators. There's a lot of things piling up right now where headline risk, and you were talking about this before, is very high. But if you go back to profits, we don't need a big expansion for profits to ultimately bottom out, most likely towards the end of this year, and then start to show the signs that we're going to begin to recover. August is an Auburn month. It's leaving the brown days, the hot days of summer, going into the October leaf-changing days of red. You put the two together, it's an Auburn-type month, consolidation, technical factors, structural factors, low volume.
But you're suggestive that we should be buying stocks now then. I mean, if we have the ability to look ahead 6 to 9 months and an improving profits picture, that today is the time to even take advantage of some of this, unsettled nature of the market and put some money to work.
Yeah, we all have been saying a variety of different things as relates to choppiness, edginess. That's been the telltale sign every time something doesn't go your way. In August, this pullback, seasonably the case, we would use this as the first episode. We think there's going to be 2 more after August and into the early part of September, one towards the end of this year, and then in spring of next year. Once you hit that nadir, that topping out of yields before the Federal Reserve starts to say, hey, wait a minute now, we might have to start to pivot a little bit sooner than the market believes. So we think there's 3 episodes of weakness. There's a lot of cash on the sidelines, and certainly there is a slower growth environment coming. But you have to have plans ready right now. Most people are still under their benchmark, Scott, in terms of their exposure to equities. And if you're long-term, when I say long-term, you just have to think about into later 24, into 25, and the market should start to adjust your way in a positive way. So dollar cost averaging, starting now, makes sense to us.
But you also made the case, if I heard you correctly, that you think there could be 2 more bouts of selling periods before the real opportunities present themselves. In terms of the current one, which we may be in to some degree, we're down today and we've been down, the last couple of weeks have been unsettled. How much of a correction do you think we're in store for now?
Typically when you get slow volume months like August, 3 to 5% makes sense to us. I don't see any much more than that. If it comes a little bit more than that, it's a bigger opportunity. The big Magnificent 7, if you want to call it the Grade 8, whatever it may be, they push the market's valuation up. In our opinion, justifiably so, because if you're going to see slower growth, you do migrate towards those areas that are going to give you the growth. The story early and late 22 was those Magnificent 7 areas, the big mega tech, were slowing down in their revenue growth. And what they showed us was, yes, they slowed down, but they didn't go down as much as expected. This was a relative move. Now, next year, it should be more of an absolute move. So from our perspective, everybody likes to wait. They want to catch a bottom. Market timing doesn't work. It's time in the market and rebalancing when the market activity gives you the opportunity to do it.
Don't you think it's going to be hard to convince people to get out of fixed income or a 5% money market and take what feels like a lot more risk in stocks?
It is hard, it's difficult until yields start to crest and start to come down. Then you start to see that activity pick up. And we're suggesting extending duration right now with the understanding that there's a lot of treasury buyers out there that don't want as much exposure as they did before to longer dated treasuries. So you get a drift up in yields, worries about the deficit, and all of a sudden when the slow growth activity starts to hit, the yield curve begins to normalize. We've got a ways to go before that. But certainly that shift from being defensive back into, I wouldn't call it risk on, but more risky areas of the market, we expect that to happen over the next 6 months for those investors who have yet to do it.
Chris, enjoy the rest of the summer. We'll catch you soon, I'm sure of that. Chris Heisey, Merrill Bank
Thanks.
of America, joining us. Up next, searching for some big opportunity. Lux Capital's Josh Wolf is breaking down where he's seeing some strength right now and how the big boom in AI is impacting his strategy. That's just after the break. And later, energy. It's outperforming today. We're going to drill down on what's behind that move. There's crude, and there's Brent as well. Natural gas is the biggest winner today at 1%. Closing bell, right back.
Alrighty, the market's trying to make a small recovery. And let's take a look and see what's going on here. Let's see what's going on here, guys. Okay. We're looking at the QQQ 10-minute chart. Let's take this to a 2-minute chart. Let's see what's really happening here. Okay, tried to make a recovery here. A little bit of an upline there. Here's the 5-minute chart here, trying to make a recovery. VWAP is 361. So we'll have to see what happens here, guys. I want to thank you all for watching and joining me here as we watch the markets kind of come down. Let's put this on a daily chart and take a look. So here we are. We broke out of this trend. Broke past the support ranges here, which I'll just delete now. So we are definitely breaking down 350. It looks like it's on its way. Let's zoom out here real quick. Yeah, you know, I wouldn't be surprised to see if it's 50% retracement from beginning of the year. I wouldn't be surprised to see it come on down to here, 322. It's my opinion. By the end of the year, we'll have to see. The 200-day moving average is 317. So yeah, I wouldn't be surprised to see it come down to the 200 moving day average, 317 right here. So we'll have to see what happens. That's the QQQ. And the SPY, probably much the same deal. We're expected to come down to 416. 200-day moving average is 411. It's a daily chart. We're definitely breaking out of this range. We're going down faster than we expected. Let's put the 5-minute chart on here. Let's see what's taking a look. Let's take a look at some other stocks real fast. Tesla down to 219.95. It's probably just go right to the daily chart here. So there's Tesla working its way down. The 200 moving day average is 196. And we're definitely on our way there. I mean, we're at 219. We did the death crosses on the 5-day moving average, 20-day moving average, and now even the 50-day moving average. We just blew past all of it, straight down. Palantir down 8.5% almost. I kind of expected that. I mean, it was just rallying off of AI. They barely earned any money. We'll have to see. It's definitely bouncing off this support here at $14. Let's take this to the 5-minute chart over here. Yep, see, bounced to 1404. It's trying to work its way back up. VWAP, volume weighted average price, 1453. Netflix is down pretty strong. But they need it. Look, see that uptrend, that line there we're on? We just went, it was way overbought. Yeah, it needs a pullback. It's very simple. Meta is pulled back. It's kind of being expected. Let's take a look at Microsoft here. Like they're pulling back. Things are looking weak here. Apple. See, Microsoft's only down 1%. Apple's down 1.5%. So Apple down 1.5%, folks. Big red day today. Let's go back to the QQQ. It's only down 1%. Trying to hold strong. Here's the 5-minute chart. See what small caps are doing. Let's take a look at some small cap, low float stocks. IDAI was the leading capper today, only 24%, so that's minimal. AHI, nothing really. Very quiet day there in the small cap world here. Nothing really going on. And there was one little push here, extremely volatile. So you figure, you know, from about $3 up to $3.33, and nothing really going on here. Novaks. So there's nothing really going on here. Very quiet day there. So U.S. Steel had a huge. I think I showed this to you guys later. They had a buy. Somebody was interested in buying them out, so it gapped up from 22.50 to 32.52. Right now, it's just kind of going sideways. Awaiting proposals and whatnot. We'll have to see what they're going to do. Bank of America's down. In fact, they've been coming down pretty strong. So you can see that. Here's a daily chart, guys. AMD. It's on an uptrend, but it increased. Look, it went up higher. Past the line. Went sideways. Now it's below the line. So let's take a look at that 10-year yield. 430. Not good for the markets. Let's take a look at the Dixie's relative strength of the dollar. The system's running a little slow here. $103.45. So it's definitely increasing, and with the 10-year yield going up, it's not looking good. So there we have, that's AMD. Let's get back to the QQQ. Let's see what's going on here. We'll bring up a 2-minute chart. Some fighting pressure here. Kind of interesting. Let's see what's on the news here. No? Okay. What about TD America Trade Network? See if they got something going on.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience that pushes you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Yeah, let's take a look at this, guys.
Watch us live on the floor of the New York Stock Exchange, where we bring you breaking news, experts, CEOs, influencers, and analysts. It's all available on Schwab Network.
Breaking down. Here's the 5-minute chart up here.
Hawaiian Electric shares down big. Jenny Horn's got the story for us. So how's it connect to the fires, Jenny?
You know, Oliver, this has been a brutal move to watch this week, as now we're seeing the stock pacing for its lowest close in nearly 37 years, after they have now been blamed for a lot of these wildfires, obviously the tragic situation that has been ongoing in Hawaii, but we got reports they're in talks with restructuring firms to explore legal and financial options, again, following being blamed essentially for a lot of the devastation that has occurred in Maui. Now, the report does indicate the utility company determined back in 2019 it needed to take further steps to prevent its power lines from emitting sparks. But leading up to the wildfires in Maui, they actually made little progress on that. Instead, they chose to focus on a shift to cleaner energy. So the company has faced criticism over they were taking the appropriate measures or not to shut off some of these hazardous fire conditions and your power lines they're being associated with contributing to. Now, a separate report out of the Wall Street Journal does indicate the company is also in talks with some of these companies over restructuring advisory work as it considers to deal with then the result of these major financial woes. With this move lower, like I said, pacing for one of its worst days since November of 1985, extending its losing streak now to the 8th straight session. Earlier this week, the company's credit rating was downgraded to junk at S&P Global on concerns of lawsuits as well as other factors. Shares have lost about 65% this week. They're now down 71% for this month and 74% for the year. I mean, you could just see their drop has been absolutely brutal. We did also see a B of A analyst maintain with an underperform rating on shares and a price target of $11. That was actually, or $10 lowered from $11 a share. There's only 4 analysts that cover this name, no buy ratings. There's 2 holds, 2 underperforms. I think what is concerning right now is bankruptcy talks, and that's basically what this Wall Street Journal report alluded to is what sort of happens next. Obviously, they're going to try to mitigate that situation, but it has been a pretty brutal story, and you don't want to be sort of the poster child for being blamed for a lot of this devastation that has occurred in Hawaii.
Yeah, for sure. And it sounds like right now at best the class action lawsuit alleging that they exacerbated it. So reminding me a little bit of PG&E from the California situation. And that stock has not been the same since. So this is the type of thing that can totally change the perception of the business and the brand going forward. So a good heads up for one to watch connected to this is these stories manage to find their way into publicly traded markets always, one way or another. Thanks, Jenny. Let's do some trading, and let's talk about the session here going into the closing bell. Going to refocus ahead of in the next 15 minutes, given stocks continue to stay near the lows. Bob Iacchino joins us, founder and chief strategist at Path Trading Partners, who's watching Bitcoin among other things here. Let's start there, Bob, because it does seem like the last couple of days we went from like what maybe could be described as a sideways move in risk assets or a pause to now like closing below moving averages, breaking through levels. And I feel like Bitcoin kind of is in that camp right now.
Yeah, good afternoon, Oliver. This is part of the reason that I never really wanted to buy and hold Bitcoin again. As you know, I was trading it to the long side, and I had a target of around 28,000. I got out of those longs. Could have gotten a little bit more out of it, but that's okay. I mean, we made money, right? But from that perspective, now you see this weakness, and this really smacks to me of the same thing that's happening with gold. Normally, you get a risk asset sell-off, and you get kind of a flight to safety, of which gold and the dollar generally participate, and we generally have lower yields in those situations because you also have treasuries headed lower. As people are buying treasuries, the yields are headed lower. We don't have that this time. We have yields headed higher, and both gold and Bitcoin are being affected by that. Effectively, gold doesn't have a yield, so if you're trying to protect your capital, you're trying to pull out of risk assets, and you have yields rising, you want to be in treasuries. And Bitcoin is falling prey partly to that, partly to its still ongoing correlation to the tech sector, which is getting hit as well. I mean, I don't think people realize, because it's been so quiet, it hasn't been a panic. So that's why you're not getting moves into gold, and to a certain degree, you're not getting moves into treasury. It's been a rebalancing or a repricing. The S&P is down 11 of the last 13 sessions. That's pretty quiet. Like when you think about it from that perspective, 3 weeks in a row, if we don't reverse the entire week tomorrow, it's been a while since we've seen that. And Bitcoin's having its worst week since May. So, these are factors that are going straight to the yield story and straight to this idea that inflation might be a little stickier based off the FOMC minutes and some other things that we saw.
Do you think the breakout in yields is necessary? We got it in the 30-year. We're watching the 10s, watching the 2s, but it's been a little bit more muted there, it seems, because we haven't heard any hyper-aggressive language from Fed speakers. But do you think that's maybe what could light a match on top of the kind of gasoline that's already flowing in bear's direction?
Well, I hope the Fed stays. Okay, so what do I hope and what do I think? I hope the Fed kind of stays on point at this point, on message. Because what's happening now is you got a little bit of a sort of mixed tone from Fed speakers just after the meeting. And now we see the minutes, and the minutes were, at least it seemed, to be much more hawkish than people anticipated from the commentary we got. Now, juxtapose that against what we're seeing in the yield curve. I mean, we now have the 2s, 10s inversion approaching a 5 handle, a 50 handle. We haven't had that.
Let's look at this recovery.
The lowest close we had in the past was negative 63.
Certainly recovering now. Things are definitely recovering here. Not going fast. Interesting. Let's put this on a 1-minute chart. Double bottom. So I see double bottom here. 358.25. There's a little bit of a topping tail in there, showing some resistance. So we got the bottom. And it's going to try and make a double top here possibly. Now this low is a little bit of a higher low. This is a lower high. So there's a slight wedge. Look at that coming right back down. So again, 1-minute chart. Here we'll show you the time of sales here going by. These are all the shares being bought and sold. Reds sell, greens buy. It's about 8 minutes left to the closing bell. This is when things can get pretty aggressive. See what else is going on here. QQQ, SQQQ, TQQQ. What else we got going on here? Ford's taking a big hit. Intel. Yeah, it's taking a big hit here today as well. 33.57. 32.60. It's a whole dollar. AT&T, oh, they're just kind of holding. They're trying to keep their stuffs around $14 a share. So let's get back to see what's going on here with let's put this back on, say, a 10-minute chart. The QQQ. I know you guys want the SPY. Okay, well right now the SPY's down 0.66%. QQQ's 1% down. So here we go. This is the SPY. And we'll put this on a 2-minute chart since we're into the close. See exactly what's going on here. So.
All right, we're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down the crucial moments of the trading day. Plus, Pippa Stevens digging into. Christina Partsinevelos back with us to look ahead to Applied Materials. The earnings out in OT. and options plays Jessica Inskip telling us the key market levels we need to watch. Michael, a lot like yesterday. Volume, 400 million number, getting a little bit uglier as we head towards the close.
Yeah, and look, I wouldn't really hinge too much on it being relatively quiet.
Here.
Yes, it has been fairly orderly, as you were saying before, but you're starting to deepen a little bit. The downtrend is taking a sharper turn lower. At this point, we've gone back to late June levels, so you kind of got rid of that final thrust higher in July. And what we're waiting for now tactically, as I've been saying for a couple of days, is for it to get a little bit more oversold and stretched and having enough of a kind of broader washout type feel to it. We're not really there. I think by the time we get tomorrow's kind of postmortems on today, we start people say, yes, some of the conditions are lining up for a tactical low. Yields are still obviously over everybody's shoulder. And I think that the confusion is a reacceleration in a late cycle economy, yields going higher without really repricing the Fed. It seems like yields are trying to restrain demand in the short term. We don't know what the economic implications of that are going to be.
All of this happening, of course, only a week ahead of Jackson Hole. It just makes the build-up and the backdrop all the more important.
It does, but I also think we have this dynamic where we're grabbing for things and seeing ghosts in every direction because the market action has been, so treacherous, at least in the last little while. So I do agree that the stakes are rising, but I don't necessarily know that everyone has a clear idea of what they want to hear out of Jackson Hole. They just know it's something hovering on the horizon.
Yeah, that's for sure, and a good point you make. We'll talk to you in a bit. Pippa Stevens, one sector in the green today. It's yours, energy.
Yeah, that's right, Scott. Energy is the only sector in the green, and that's because oil is higher, making back some of the losses from the last 3 days as focus is shifting to falling U.S. inventories rather than weak economic data out of China. And so that is supporting energy stocks, which once again only S&P Group higher. Now, the upstream players, which are the most correlated with commodity prices, are the outperformers. Refiners are also in the green. But we are seeing modest weakness in some of the oil field services names, with Baker Hughes and Halliburton in the red. But the OIH has led in recent months due to optimism around a ramp up in international and offshore. Now, one area to watch is the midstream names. Deal activity there is heating up, with Energy Transfer saying it will buy Crestwood Equity Partners for $7.1 billion. With a lot of hurdles around building new pipelines, the infrastructure that is already in place, Scott, is looking increasingly valuable.
Pippa Stevens, thank you very much. Christina Partsenevelos, AMAT's down 5% thereabouts heading into this number.
Well, if the beats by competitors Lam Research and KLA are a barometer of what's to come, then Applied Materials should post better than expected results today after the bell. So, leading edge, this is just a breakdown. Leading edge chips power supercomputers, laptop servers, etc., while lagging ones are used to make up the bulk of other components like electric vehicles and HVAC systems. So, chip equipment maker Applied Materials is highly exposed to those lagging nodes, and there is massive demand still coming from China. Applied Materials also has some exposure to AI. Its machines help with advanced packaging and high bandwidth memory used on those leading edge AI chips, so that could be seen as a boon for guidance. But Mizuho suggests the cyclical slowdown coming in the September quarter is because why investors should actually put Applied Materials with Lam Research as well as KLA, aka in the camp of waiting to add on further stock price pullback. Scott?
Yep, I'm looking at it down 5% or so over the last month heading in. Christina, thank you. We'll see you afterwards with exactly what they delivered to Jessica Inskip. Now, oh, by the way, Mike Santoli, we'll see you at the top of overtime, but thank you as well, obviously, to you. Jessica Inskip, now to you. The levels, what are we watching? What do we need to pay attention to?
Yeah, so we're definitely jogging in place. We've got that bearish seasonal overhang that's in full swing. Good news is we're getting to the bottom of those trading ranges. So NASDAQ 100 is the line leader. They lead the rallies. They lead the declines. Their next support level is around 13,950. Now, NASDAQ 100 has already broken its 13 weekly moving average. That's extremely important because that represents 1 quarter of prices. We're above 1, 2, and 3 quarters. If we fall below and close a week below that 13 week, I will raise a flag there, and that's something to be of concern. So that's 14,300 is the April gap where we have the downside risk too that I want to pay attention to.
You think we've seen a decided trend change? Can we make that call yet in tech?
I do not think so. Absolutely not. I think if we look at the broader picture, as in let's talk about how there's GDP growth and there is such a slowdown in the labor market, the productivity that we see there is the health, the pulse of that, and that is all with technology and AI and that boom. So that's necessary. That will translate to earnings. That's going to take some time. We just are very, very oversold at the moment. There has to be a rotation. There needs to be broadening out. We're going to get to the bottom of that trading range, great buying opportunity, and then we'll go right back up. Perhaps we'll consolidate, but that's going to translate definitely broader bull. I am definitely a bull in the longer term, consolidation in the short term.
Yeah, Apple is an important one to watch, talking about consolidation. I thought our poll was very telling, with half of those who voted suggesting, yes, stock's going lower. We asked, could it go to 150? Comment on Apple as I look at it down another 1 1/3%, how important you see it right here, where you think it may be going from here.
So very interesting. 173.26 is actually Apple's 26 weekly moving average. So that's the 2-quarter price. That I want to see that close above 173.26, which is we're hovering at right now.
Markets are officially
that could
closed.
be the area of support, sending it rebounding. I think 150 is
and as we
low,
can see,
but from a technical
the S&P
perspective, this is
500
its
failed.
testing moment right now.
Yeah.
Tried to break out.
I love you technicians. You get right specific, right down to the penny. Jessica, thank you. I appreciate that very much. That's Jessica Inskip. You hear them cheering, but for the second day in a row, the cheers don't match.
Yeah, they're cheering all right.
Because the Dow's going to close not at its lows, but not that far off either. And things certainly deteriorated a bit over this final hour of trade. With that, I'll see you tomorrow. I'll send it into overtime with Morgan Brennan and Mike Santoli.
And their yields kind of holding. Markets are down.
Well, another ugly finish as stocks add to their August losses, and the S&P closes below 4,400. That is the scorecard on Wall Street. But the action is just getting started. Welcome to a special edition of Closing Bell Overtime. I'm Morgan Brennan, joining you today from Sag Harbor in the Hamptons.
And I'm Mike Santoli, in for John Ford at the New York Stock Exchange. Coming up in just moments, we'll get earnings results from $115 billion market cap chip equipment maker Applied Materials, along with discount retailer Ross Stores and payments firm Bill Holdings.
And we've got a great lineup of guests here in the Hamptons this hour, including Wes Edens, the billionaire co-founder of Fortress Investment Group, co-owner of the Milwaukee Bucks, who is also the founder of high-speed passenger rail company Brightline and the CEO of New Fortress Energy. So much to get to with him. Plus, real estate titan Howard Lorber, the chairman of Douglas Elliman Real Estate, will talk about the surge in mortgage rates to their highest level in more than 2 decades and what he's seeing in real estate. We'll be joined by billionaire astronaut and the founder of and CEO of payments company Shift4, Jared Isaacman, for his read on the consumer, the fintech landscape, and so much more. We have got such a huge hour, Mike.
Sounds fun, Morgan. We'll absolutely see you in a few minutes with those guests. But first, let's begin with our market panel. Joining us now are Dana Dioria from InvestNet, and Adam Crisafulli from Vital Knowledge. Welcome to you both. And Adam, let me get started with how you're interpreting the action we've seen. We got the S&P 500 basically in a 5% pullback. A 5% pullback after a 20% run pretty much could happen for any reason, but there's a lot of reasons being thrown out here, from yields to concerns about the Fed to bad reactions off of earnings, and maybe inflation picks up again. What's your read?
There's a little bit of a higher low.
Yeah, I think the primary catalyst, it's mostly technical in my opinion. I think you had a lot of people dive into equities in July. So there's a positioning and sentiment now that flips into being a headwind. But I think fundamentally, the biggest change in the last couple of weeks has been the narrative around inflation. We've had a months-long process of disinflation driven by base effects, driven by commodity prices, and a couple of other factors. And I think the July data on the CPI and PPI has created concern that that process is now stalling or possibly even reversing. And I think that, more than anything, has contributed to what you've seen in yields, and then that's fed back into equities and caused a slump that we've been in. The other critical components of the market, earnings and underlying economic growth, are both doing very well. If anything, I think both those are in a better position than they were just a couple of weeks ago. The recent economic data has pointed to a modest uptick in momentum, and then the July earnings season, which really kicked off this week, has been pretty stellar. So Cisco and Walmart were the two big ones out last night this morning. Then you had Home Depot, even Target. I don't think was nearly as weak as feared. So it's primarily, in my view, a change in the narrative around inflation.
Dana, how would you approach it as an investor when you're presented with a stock market that certainly has some questions around its valuation near the highs? Maybe they're still with us, and then you have the opportunity or perhaps the risk of longer-term Treasury yields pushing 15-year highs. What do you think the market is presenting you with in terms of decent options here?
Yeah, well, I would echo a lot of what Adam said, and I think that being the case, leaning defensively is probably still a good place to be, right? So we know if you're in the market, we represent retail investors. I mean, regardless of whether they're in an index fund or they're in an actively managed model that's sort of closet indexing or low tracking error, they're all getting a big chunk of growth and tech communications, right? The enormous 8. So to the extent that you're going to tilt away and you can tolerate some tracking error, I would say to position a little bit more defensively, right? Look to quality, look to a sector like healthcare, for example, and low volatility, right? So that you can give a little bit more ballast to the equities in your portfolio.
Yeah, I mean, certainly the higher volatility, higher beta stocks have borne the brunt recently anyway. And by the way, we do have Applied Materials raw stores numbers are out. We're going through them. We're going to have them for you as soon as they are ready. You see the stocks both reacting initially, at least, to the upside. Adam, if you feel as if this is just kind of maybe a somewhat routine and technical reset of the market lower, how does it play out from here? Because a lot of folks will say, it can kind of feed on itself for a while. Maybe there's a recognition point that there were risks in the economy, either of short-term overheating or of tipping us into recession that we weren't really appreciating a month or two ago.
No, so I think that, just looking forward, I guess the biggest problem is more just an issue of when do we get the next update on inflation? And so we don't get the PCE for July, until the end of August, and then you're looking at nearly a month from today when you get the August CPI, just to get another look at the evolution, the trajectory of inflation going forward. But, I kind of look at just the core underlying fundamentals, and, you're seeing it right now with another round of July end earnings on raw stores and AMAT. If companies continue to perform like this, and they did in Q2, and they're doing it so far with the July end quarters, and growth stays on a healthy trajectory, I wouldn't say that it's necessarily overheating. There definitely are enough red flags on the growth front that I think it's going to give the Fed some pause. But until I see a real sharp change in earnings, it's hard to kind of really say this is anything other than a normal, healthy pullback that's